All right, let's get right into it. All around the world, governments are cooking up a brand new kind of money. We're not talking about cash and we're not talking about crypto. This is something totally different, and it could completely change how all of us pay for, well, everything. And look, this isn't some far off futuristic idea. A 2023 survey from the Bank for International Settlements found that a whopping 94% of the world's central banks are already deep into exploring or even piloting this new digital currency. So, yeah, this is happening right now. So, what is this stuff they're building? It's called a Central Bank Digital Currency, or a CBDC for short. The easiest way to think about it is as an official digital version of a country's cash. It's in the same currency you use every day, like dollars or euros, but it's issued directly by the central bank, making it a direct liability of the state, just like the $20 bill in your wallet. Now, you're probably thinking, wait a minute, how is this any different from Bitcoin or just the money in my banking app? And that's the perfect question. You see, unlike crypto, a CBDC is centralized and regulated by the government, so its value is stable, no wild price swings. And unlike the money in your bank account, which is technically a liability of a commercial bank, a CBDC is a direct claim on the central bank itself. That means it isn't at risk if a commercial bank fails, which would make it, by definition, the safest form of digital money out there. Okay, so we know what it is, but how do you actually build one? Well, it turns out it all boils down to making four fundamental choices. It's kind of like having a blueprint for the future of money. And this image right here, this is that blueprint. It's called the CBDC Design Pyramid. Each layer represents a core decision, and they all build on each other, right from the very foundation of the whole system. So let's start at the bottom of the pyramid, the architecture. This is the first, most basic decision you have to make. And the question is pretty simple. Who's going to run this thing? You've basically got two main flavors. First, there's a one-tier model. It's direct, the central bank would handle everything and deal directly with you and me. But then there's the two-tier model, which looks a lot more like the banking system we have today, where commercial banks act as the go-betweens, managing our digital wallets and services. This approach uses all the infrastructure that's already in place. All right, let's move up one layer to the next choice, the ledger technology. Once you know who's running the system, you've got to decide exactly how every single transaction gets recorded and validated. Now, this is where it gets really interesting because it's all about trade-offs. You could use a traditional, centralized database, or you could use a distributed ledger technology, which most of us know as a blockchain. As you can see here, different types of ledgers have different pros and cons. You're constantly balancing things like speed, cost, and how decentralized you want the system to be. The choice made here has huge consequences down the line. Okay, we're halfway up the pyramid now. The third decision is all about access. In a digital world, how do you actually prove that the money you claim to have is, yours? It really comes down to a simple question. Is it based on who you are or what you have? An account-based model links the digital money to your verified identity, pretty much like a bank account does today. A token-based model, though, is more like digital cash. Your ownership is proven simply by having a secret digital key. And this is a really crucial difference, especially when you start talking about privacy and the ability to make payments when you're offline. And that brings us to the very top, the peak of our pyramid. After you've decided on the architecture, the ledger, and the access model, there's just one final question left to answer. Who is this digital money actually for? On one hand, you could build a retail CBDC. That's for everybody, you, me, or neighbors, to use for everyday shopping. The big goals there are usually financial inclusion and just making payments more efficient. On the other hand, a wholesale CBDC is more of a behind-the-scenes tool, just for banks and financial institutions to settle massive payments with each other. The goal there is to make the entire financial system work faster and cheaper. So, there you have it. That's the blueprint. Those are the four key decisions. But what are countries actually building in the real world? Let's take a look at the data from 26 projects that are already underway and see what choices they're making. When it comes to architecture, the results are pretty overwhelming. A massive 92% of projects are going with the two-tier model. It's clear that central banks would much rather partner with commercial banks they already work with than try to manage millions of individual accounts all by themselves. And what about the ledger? Well, a clear majority, 65%, are using some form of distributed ledger technology. That's a huge shift away from the old-school, walled-off databases of the past. It shows a real move towards a more modern and hopefully more resilient financial infrastructure. And how are they handling ownership? More than half of all projects are choosing a token-based model, and that tells you something really important. Features that act like physical cash, like having more privacy and the potential for offline use, are a huge priority for the people designing these systems. And finally, who is this all for? The focus is clearly heavily on the general public. If you add it up, a combined 81% of these projects are either purely for retail use or a hybrid that serves both retail and wholesale. So, making payments better for everyday people is definitely a primary goal here. So we can see the blueprint really taking shape, and there's a pretty dominant design that's starting to emerge. But, it's one thing to have a plan on paper. It's another thing entirely to actually make it a reality. There are some huge questions that have to be answered before this digital money ever makes it into your pocket. And these are the big four that everyone is wrestling with. First, privacy. How do you give people the anonymity of cash without creating a playground for illegal activity? Second, security. How do you possibly protect an entire nation's digital currency from hackers? Third, and this is a big one, adoption. Even if you build the world's greatest system, how do you get people to actually use it? And finally, disruption. What happens to traditional banks in a world where CBDCs exist? And that adoption problem, it's not theoretical. It's very real. Just look at the sand dollar in the Bahamas, one of the world's first live CBDCs. After years, its total circulation is just half of 1% of the physical cash in the country. It turns out, building the tech is one thing, getting people to care is a whole other mountain to climb. So a digital version of cash is no longer a question of if, but of how. And the design choices being made right now in rooms all over the world are going to have massive consequences for our privacy, our security, and our economy for decades. Which really just leaves us with one final crucial thought. Who should get to decide how it all works?